Good evening to one and all. Am I audible to everybody?
Yes, sir, you are.
Yes, Saurabh sir, you are audible. Good evening.
Yeah.
I'm sorry for the background traffic noise. I'm muting myself.
Good evening to one and all. I, Professor Saurabh Shrikant Jadhav, Training and Placement Officer at Magarpatta College of Hospitality Studies, Pune, takes this opportunity to warmly welcome you to today's national webinar. Our college, in collaboration with the Association of Mutual Funds in India, AMFI, has organized this enlightening session on two key topics: strategy for effectively managing personal finance and the future of tourism, emerging trends and technology. We are proud to be a part of this collaborative effort. Magarpatta College of Hospitality Studies, Pune, Maharashtra, established in 2016 under the visionary guidance of Dr. Yogesh Magar, an alumnus of IHM Mumbai and IMI Lucerne, Switzerland, has rapidly grown as a premier institution dedicated to shaping the future leaders of the hospitality and hotel management industry. At MCHS, we are committed to more than just imparting knowledge. Our goal is to shape the future of the hospitality industry by blending tradition with innovation. We understand the dynamic nature of the hospitality sector, and our unique approach ensures that we produce well-rounded, industry-ready professionals. Currently, we offer a BSc in Hospitality Studies course affiliated with Savitribai Phule Pune University. Without further ado, I now call upon our honorable and respected principal, Dr. Ujjwala Sanaune, to inaugurate and welcome all of us to this exciting webinar. Over to you, ma'am.
Thank you so much, Saurabh sir. I take this opportunity to welcome everybody, and I can see that we have quite a number of participants. So it's a nice gesture that we have a good number of participants. So good evening, everyone. And I am really honored to welcome you to this webinar here today on strategy for effectively managing personal finance. I would also like to welcome Mr. Suryakant Sharma. He has over 35 years of experience in banking and finance and securities markets. I have personally attended his session earlier, and I found the session really very interesting and definitely more interesting for the uh, student community today and for uh, the youngsters who have just recently started working. And I'm sure he's going to guide us today on how to manage our own finances depending on how much each person is earning and how much we need to serve. I'm looking forward to this webinar as well today to absolutely get some invaluable insights of how to manage your finances. So looking forward to you, sir, and thank you so much for being with us today and guiding our audience. Thank you so much, sir.
Thank you so much, ma'am. And it's my privilege to introduce our today's keynote speaker. Dr. Suryakant Sharma is a postgraduate in commerce and law with specialization in corporate laws. He is also Chartered Associate of Indian Institute of Banking and Finance, IIBF. Shri Sharma has over 35 years experience in banking and finance and securities market and had initially served in a leading financial institution. Thereafter in Department of Financial Services, Ministry of Finance, Government of India, and finally in SEBI. Shri Sharma joined Securities and Exchange Board of India in 2003 and served in SEBI for more than 16 years in different departments of SEBI. Lastly, in addition to other assignments in SEBI, he was in charge of Office of Investor Awareness and Education in SEBI's Northern region for more than 5 years, and in this period, more than 15,000 financially literacy and investors awareness programs were conducted, and he himself had addressed as guest speaker in more than 600 IAPS. Shri Sharma was also a member of working group of NCERT for developing vocational course on mutual funds for students of 11th and 12th classes. Shri Sharma is also a recipient of Excellence Award from a leading trade body for promoting mutual funds in India. Shri Sharma is also mentor of a few NGOs working for financial literacy and investor awareness in the country. After superannuation from SEBI in 2019, he has joined Association of Mutual in India (AMFI), an apex body of mutual fund in India, as senior consultant for spreading financial literacy and investor awareness across country among citizens. Since May 2019, Shri Sharma has interacted with lakhs of investors and potential investor students through more than 1,000 investor awareness online webinar and on-ground physical program across country in reputed government organizations, research institutions, leading educational professional institutions, corporates, startups, women-centric NGOs, and others. I welcome on behalf of Magarpatta College of Hospitality and Mutual Funds to start the webinar for the same. Over to you, Suryakant
Mention
Sharma.
here that this program is from Association of Mutual Funds in India, AMFI, which is an apex body of mutual funds in India. But my dear friends, this is not a marketing event or a promotional event of mutual funds. It is purely an investor awareness program. And the purpose of this program is just to sensitize participants, and in this case, women students and women teachers even, the importance of money which you are earning and how you can make money out of your money. That is more important. Because when we earn money, majority of our money which we earn goes into taking care of our normal expenses. But then every Indian, you will appreciate every Indian sincerely try. I will not say that they will all be making it, but they always sincerely try that they should not spend all the money which they are earning. Or rather, they should take away as much money as possible out of their earning. And the money which we don't spend out of our regular income, my dear friends, it is called savings. And saving is the first step for your prosperity and wealth creation minded. And we are very fortunate that our generations together, we have been one of the top savers in the world. Still, we should be proud of it, that Indians are still one of the best savers in the world. And it is not happening this generation. This is prevalent for last so many generations. We have been savers. We have been savers. Every family, may they be earning 10,000 or may they be earning 10 lakhs. Every family try to save as much as they can. Why? What is the reason? Because they know it very well that in future they will be needing lot of friends because we made 3 mistakes in our life as far as savings are concerned. And these 3 mistakes I want to share with all of you, particularly young faculty members, your students even, because of the only purpose that they should not make these mistakes. First mistake is, I was very casual in saving at the initial years. Honestly, I didn't save. In the first 3-4 years, there was a blunder on my part. And I had to repent throughout my life that I had not started my saving right from the day one when I started earning. Because had I done it, I would have much more money which I had today. So first thing I want to tell all of you, please start saving right from the first month when you start earning. Don't waste even a single month. Right from the first month you start saving, and you should not feel shy of saving a small amount, because normally it happens when we start our career, salaries are not great. Even in business, profit is not great. Even in profession, we might not be getting good profession. So what I want to tell you, that whatever amount you could save, maybe 100 rupees, maybe 1000 rupees a month, but you must start saving right from the first month you start earning. Don't lose even a single month. This is the first request I want to make all of you. Second request is, kindly be religiously regular in saving every month. Every month you have to save. Every month. Every month you have to save. And third request is, please keep increasing your amount of saving every year, because your income will increase. Every year you will get increment. You are in job. Even if you are in a business, your profit will keep increasing every year. Even when you are in a profession, your profession will settle down and you will start earning more money. So with the increase in income, we must increase our savings as well. And a thumb rule is there. If you can follow this rule, it is a very golden rule, a very important rule. Please keep increasing your saving minimum by 10% every year. Every year. Suppose today you are saving 1000 rupees a month in the first year. In the second year, it should be 1100 rupees. 10% increase. In the third year, it should be 1210 rupees. That is incremental increase of 10% from rupees 1100 to rupees 1210. Likewise, every year, not 1 or 2 or 3 years, throughout your life, as much sincerely as you can, keep increasing your saving with the increase in income. And if you can, make it minimum 10% increase every year. And I again repeat, incremental increase. Not that you start with 100 rupees and then you next year you started 110 and it is 110 all throughout your career. No, 110 is only for second year. For third year, it should be 1210 rupees. So please mind it. Every year increase in 10%. These three things look very small, but I can tell you with my confidence, my dear friends, and the mistakes I made, I can tell you with confidence, please religiously follow this golden rule of saving, and 3 golden rules I just mentioned. Please follow it. Now the second question arises, what to do with the savings which we are making, and rather which we will be making. What to do? There are 2 options. Again, we faltered. Again, we made a great mistake. Rather blunder, I will use it. I saved. My generation also saved. But unfortunately, we kept the saving at home in a box or a kitchen boxes. And you might remember your mother, your grandmother, your elder female members of the family, how they could have saved 1 rupees, 2 rupees, 5 rupees, 10 rupees. But they kept the saving into kitchen boxes or in their hidden boxes. So they kept the saving at home. That was a blunder. Never, never, never keep your saving at home, my dear friends, because the purpose of saving itself will be defeated if you keep the money at home or keep the money of saving at home. Because, and I will rather use a very harsh word, it is a crime. It is a crime against yourself you are committing yourself against you. You are committing crime against your family, and crime you are committing against our country as a whole. Because if we save the money and keep the money at home, the currency of the value will keep diminishing every year. And side by side, we are keeping money out of circulation, because the basic economics rule is more circulation money will have, more people will get benefited. So please never keep saving at home. Then there is another option available with all of us. That is, deploy your saving or put your saving into one or other product. There are plenty of products available in the market where you can deploy or put your savings. And the process of putting or deploying your savings is called investment. It is called investment. So you not only have to save, because without saving nothing will happen. What you will invest? So first, saving is the first and foremost step in your life. But you must not stop at saving. You should deploy your saving into one or other product, and the process is called investment. So you have not only to be saver, but also you have to be investor. And what is the purpose of investment? Why we should invest? The purpose of investment is very simple and distinct. The money which I have saved, the money which I have deployed in one or other product, should also start earning money for me. So down the line, after 10 years or so, you should have two channel or two stream of income coming to you. And both the streams are very, very important. The first stream is whatever you are doing. You may be a teacher, you may be a government officer, you may be a private executive, or whatever you are doing, you will keep earning money for you, but that is only through work, hard work rather. But there is other stream where only your money will work. You will sit idle, you will enjoy, but your money will continue earning money for me. And my dear friend, that is called investment. The purpose of investment is very simple. I again repeat, your money should earn money for you. Your money should earn money for you. And a time will come in your life one day, my dear friends. Of course, it didn't come in my life, very honestly speaking, I admit. But it will definitely come in your life, provided you work hard and work sincerely for management of your money, which of the subject which we are talking about. And the money will start earning more money to you over a period of time. So that second stream of earning money is very important, or sometimes rather more important, because there is a limitation of earning money through your job. There is a limitation. You will get salary, fixed salary, then increment like that only. But if you are a wiser investor, if you invest your money wisely right from the first month, then sky is the limit. You can make crores of rupees from your investment. That is why this channel is equally important to understand how we can make more money work for me. How I can make my money work for me. Firstly, I will work, that I will earn a salary and other income. And secondly, my money will also start earning money for me. So I will be more talking about the second stream, that is making money out of our money. And this is called investment, and the purpose of investment is that my money should make money for me. And why we invest? Because we know it very well that in future we will be needing huge money in our life for major milestones in our life. Huge money. I'm telling you, every even middle class, salary class person will need crores of rupees. Mind it what I am saying. A normal middle class, salary class person will need crores of rupees in their life for major things or major work in their life. And that crores of rupees might not come only through salary. Mind it very clearly. It might not happen that there are exceptions of those people who are earning 10 lakhs rupees a month or 15 lakh rupees a month, but hardly there are any lakhs. What about crores and crores of normal middle class, salary class person? So how they can have crores of rupees in their hands when they will need it? Yes, my dear friends, it is possible, and that is possible only through investment. So please mind it. Till today, India has been a country of savers. We have been a country of savers because saving is in our blood, you all know. But now the time has come, my dear friends, that India should now be a country of investors. Because only through investors we will prosper individually, and my country will also get prosperity. So it is basically a journey we have to undertake from saver to investor. And then a whole emphasis of today's financial literacy and investor awareness is every individual has to be investor. Every individual, whatever they might be earning 10,000 rupees, they can still be investor. Or you might be earning 1 lakh or 10 lakhs. You can easily be investor. But even those who are not earning well can still be an investor by putting their savings into one or other product. So saving is important. Saving is the first step. Investment is the second step. And only through investment we can create wealth. Wealth creation is possible only through investment. Mind it, not through salary. Through salary we can save. That is the first step. And again I repeat, it is the most important step. But you must not stop at the first step. You have to postgraduate from saving to investment. So investment is the crux of your comfortable life. Investment is the crux for your wealth creation. And through wealth creation, you will be prosper. So, my dear friends, the chain is very simple. Save the money, then invest the money which you have saved, then earn good return on your investment, then keep reinvesting your return on investment, keep creating wealth, and through wealth creation, you can be prosper. So this is a chain which we have to follow for our prosperity. Prosperity will not come in isolation. It will not come in isolation. You have to work firstly on your saving. Then you have to sincerely work on your investment. Then you will have to work on your return. And then you will have to work on your wealth creation. Then automatically prosperity will usher in your life. Why it did not happen in my life? Why it did not happen in my generation? Very honestly, most of the middle class, semi class person always struggled throughout their life as far as money is concerned. We hardly have sufficient money even for pulling over our life, even what to talk of comfortable life. We were literally pulling over our life because we didn't have sufficient money. And we knew it very well that if we have reasonable money or sufficient money in our life, we can enjoy good life. We can give comfortable life to my family. We can give best education to my children. And we can lead a comfortable retirement life. So that is why every individual has to have reasonable and comfortable money in their life. But that is, I again repeat, not only through saving. Saving is the base, of course, but that can be happen only through investment. So please understand that investment is the one of the most important tasks in our life. But in investment, you have to take care of some basic rules of investment. The first basic rule of investment is that you should try to earn real return on your investment, my dear friends. You see, the first rule of successful investment is you should try to earn real return. I'm using the word real return, not return. There is a difference between return and real return. And what is the difference? Return is the money which we earn on our investment. Suppose you make an FD of 10 lakh rupees at 6% for 1 year, you will earn 60,000 as interest and return. But that is return only. And this return is notional return, my dear friends. Mind it. This is not real return. There is a difference between return and real return. The return which we get on our investment is called return, or you can take it notional return. Then what is real return? Real return is when you subtract inflation rate from return plus tax liability, if any, on your return. You have to subtract it. Suppose you earn 60,000 rupees interest income on your bank FD of 10 lakhs rupees. But you minded one more thing kept happening every day. That is prices of goods, item or services kept increasing. So last year, suppose whatever you could have purchased from 10 lakh rupees, had you not gone for the bank FD, can you tell me, would you be able to get same item, same goods and same services after 10 years? After 1 year at 10 lakhs rupees? No, we know it very well. It will not be possible. Because of inflation, prices of those items have increased. Suppose inflation rate has been 5%. What does it mean? That whatever you could have purchased last year at 10 lakh rupees, after 1 year from the same goods, same services and items, you will need to pay not 10 lakhs rupees, but 10 lakh 50,000 rupees. So see the real issue. Out of 60,000 which you earn as return on your investment, 50,000 has been eaten by the inflation. You might still feel satisfied. Okay, no problem. Let 50,000 go, eaten by the inflation. I still have 10,000. No, my dear friends, there is another problem, and the problem is government take taxage on your return. Mostly, except some very few government where a government doesn't take taxes, or those are exempt from taxes. Very few only. But in most of the return, you will have to pay tax also. And in the case of FD, rule is very clear. Whatever you earn as your interest income will be treated as your income, and you will have to pay income tax as per your slab on this return. So suppose you are in 20% income tax bracket. So you will have to pay 20% income tax on 10,000, on 60,000. What it becomes? 12,000. 12,000 rupees. You will have to pay as income tax. Now you see the proposition. You are very happy when you got 60,000 as interest, and you are enjoying. You are celebrating that I earned 60,000 rupees on bank FD. But in reality, out of 60,000, 50,000 has been eaten by the inflation, and 12,000 you have to pay as income tax. Now the total comes to 62,000, and you earn only 60,000. So literally it was a losing proposition. In reality, you got nothing. So there was no real return. What I want to emphasize here, the 60,000 which you earned as return on bank FD was your notional return. So you have always to see that you earned real return on your investment. And real return, a formula comes out of this example. Real return equal to notional return, that is the return you get, minus inflation, minus tax liability, if any. And unless or until you earn real return, I again emphasizing, you will not be able to create wealth. And if you are not able to create wealth, then you may not be prosper. So again, I tell you, what is most important here is to make investment, but also to see that you earn real return on your investment. But why we didn't earn real return on investment? Why? Why my generation didn't earn the real return? There was a reason, and my dear friends, and the reason lies in our mindset, not outside somewhere else. It lies in our mind. And what was the mindset of our middle class, salary class person? Yes, we want to make money out of investment. That was very natural. Everybody wants to make money. And from investment too, we wanted to make money. But I will make investment only in secured investment products. which are 100% secure, where my money is 100% secure. Only in those products I will invest. That was a blunder on my part. Because, my dear friends, you may or may not agree with me, most of the investment product has got risk, except some governmental small saving scheme. Very few schemes are there, which I will also mention if I get time. In most of the scheme, real return is literally zero in governmental small saving schemes, or very marginal real return, marginal, most reasonable. And I again repeating the word real return, not notional return. So the basic rule of investment success is that in investment, risk is there, and you have to take risk to get good return. Again, this equation is very clear. If you want to earn real return, or rather good real return on your investment, you will have to take some risk. And what is risk in investment? You might lose money, you might not get real return, or you earn nothing on your investment. That is also a risk. So please understand that in investment, risk is there. But if you take risk, there is a possibility. Again, I say no guarantee at all. If somebody say that if you tax, you will get real return, the statement is not correct. What I am saying here is, if you take risk in investment, there is a possibility that you might earn real return on your investments, or rather very good real return. So risk has to be taken. But again, we are all shy of taking risk. Why? Because nobody wants to lose his money. Nobody wants. But I tell you, we can manage our risk, or we can minimize our risk. That we can do. How? By practicing a two-word formula, that is think, understand, and invest. Think, understand, and invest. Think simply means, what is my risk appetite? I should make my investment decision strictly as per my risk appetite. Risk appetite simply means how much risk I can take in investment. And my dear friends, every individual has got different risk appetite. Every individual has got different risk appetite. Every individual has got different risk appetite. And one more thing I want to add. Your risk appetite is directly related to your age as well. It is directly related to our age. When we are young, we can take high risk. Or rather, we should take high risk. Why? Because the reason is simple. When you are young, you still have 30, 40 years to go in your life. If you make some mistake, that's very natural. We all make mistakes in our life, including in investment. So if we make some mistake in investment, we can rectify that mistake, we can correct that mistake, and we can then go to a correct path of investment. That is why what I want to tell you is that in investment, if you have to take risk, you have to take a risk as per your risk appetite. And one more thing I want to add here. Your risk appetite or risk taking capacity is not a constant factor throughout your life. No, it is not a constant factor. It will keep changing. When you are young, you can take high risk. When you cross 40, your risk taking capacity is lowered, has become much lower. When you cross 60, your risk taking capacity has become literally zero. No, you can't take risk. I can't take any risk now. I am already crossed 60. But you are young. You must take risk, because only through risk you can earn higher real return. But not blind risk, my dear friend. You must not take blind risk. You must take calculated risk. And there is a difference between blind risk and calculated risk. What is that? In blind risk, we don't know the product we are investing, but we are investing because some other person is investing. No, without knowing the product, we are investing in that. That is blind risk, and we must never take blind risk. You might lose your money. You are taking very high risk. When you don't know the product, you don't have knowledge of the product, still you are investing. And this is happening today in securities market. For last 2-3 years, market is going up and up. And most of the person who have started investing in security market don't know ABCD of security market, but they are investing because people are making money. They also want to make money. But that analogy will not work here. Mind it. You should invest in the product only after getting knowledge of the product. And knowledge means what the product is, what is the level of risk in that product, whether that risk it broadly matches with my risk appetite. So that is there. So you must take risk, but it should be a calculated risk. Secondly, one more thing I want to mention here is that I had earlier mentioned that we will be needing crores of rupees in our life. So how we can broadly ensure, how we can try to ensure that when we will be needing money in our life, we will have money in our hands. How we can ensure? Is it a way out? Is there a way? Yes, my dear friend, there is a way. That is through financial planning. And what is financial planning, friends? Financial planning is nothing but you are identifying your financial goals. And what are the normal financial goals of a middle class, salary class person? Normal I am talking about. What are the major financial goals in our life? The first, where we will be needing money. The first is marriage. For marriage, we will be needing huge money. Then purchase or acquisition of the house or flat. Again, we will need huge money. Then purchase of the vehicle. Again, we will be needing money. Then going on vacation, not once but regularly, you will be needing good money. Then one bigger thing will be happening in your life, that is higher education and professional education of children. It is one of the most important milestone in every parent's life. Every Indian parent always want that whatever he or she could not do, their children should do. They should grow beyond them. They should go more what they could do. But for that, you will have to give them the best higher education and professional education. Again, that will require huge money, mind it. Then lastly, for retirement life also, you will need money. Because in retirement life, what typically happens? The salary which you used to get from your employer is stopped. You will not be getting salary after retirement. But then you will have to live life the way you were living earlier. How it is possible? That is possible only through when you develop a huge retirement corpus for your life. And I keep telling in my session, my dear friends, even the younger ones, please start developing a retirement corpus for your retirement life right from the first month when you start earning. Why? Because huge retirement corpus will be required, my dear friends. It is more pertinent now because the average age of India has risen to 71 years. What does it mean? It simply means that even after retirement, you will be leading life in retirement mode after for 10, 15, 20, 25 years. From where the money will come? Because the regular income is gone. Your salary is gone. You have retired. That is why you should develop a huge corpus of retirement. And once you retire, put that corpus into some investment and you get regular income from that corpus on which you can survive, on which you can lead a comfortable life. That is why I keep telling you, for retirement life also, please do develop a huge retirement corpus. And these are the financial goals we should set up. And this is possible only through make your financial plan. Set and fix your financial goals. And psychologists say that who identify their financial goals, work hard. Because now you have identified for yourself your financial goals. You will need 5 lakhs rupees for your marriage. You will need 50 lakhs for purchase of house. You will need 5 lakhs every time when you go on vacation. You will need crores of rupees for your higher education of your children. And you will need crores of rupees for your retirement life. So please set your goals. And once you set your goals, your financial plan is in place. Now, please keep analyzing your financial plan, what you have done last year, what was to be done and how much you have done, and what has been the deficit in it. Make extra efforts. That is why psychologists say that financial plan will give you a directional approach. Now, direction is very clear. When you start earning money, when direction is very clear that you will be needing money when you need the money in your life, and that is only possible through financial plan. So one more thing I want to add here as far as investment is concerned, that is power of compounding. And my dear friends, power of compounding is eighth wonder of the world. Please mind it what I am saying. It is one of the most important tool for wealth creation. And what is power of compounding in investment? Very simple thing. You will have to make a promise with yourself, not with others, with yourself only. And what's the promise? That I will never consume or use the return which I will be getting on my return. I will never use it. And return might be 500 rupees or 50,000 or 5 lakhs. Amount of return is not significant. What is significant here is that I will never consume or use the return which I will be getting on my investment. And definitely you will get it. Once you start investing down the line, after 3, 4, 5 years, you will start earning return on your investment. But never use or consume your return which you get. Then what to do? Keep reinvesting that return. Keep reinvesting. And not once, every time you get return. And that is not to be done for 1 year or 2 years. It should be for the next 15, 20 years. So make it a promise with yourself that I will never consume or use the return which I will be earning on my investments. What I will religiously doing it, I will keep reinvesting that return every time. I'm telling you, not once, not twice, every time in the next 15, 20 years. And if you do, my dear friends, down the line after 15, 20 years, you will have huge money in your hands. That is why power of compounding is a magic as far as investment success is concerned. Keep reinvesting your return. And again, I repeat, not once, not twice, not thrice. Every time you get return, keep reinvesting it for the next 10, 15 years. So power of compounding is a magic. And one more thing I want to tell you about investment is, never put your all egg in one basket. This is an adage you might have heard. What does it mean? Don't put all your money in one product, investment product. It is very riskier. Don't put all your money in one product only. Keep diversifying your money into different products. You should invest some of your money in the investment products which had got no risk or very less risk. But you should also invest some of your money into the products which have got relatively high return, high risk. And you should also invest some of your money in the product which has got highest risk. Because in highest risk, there is a probability of getting high return. In the product which has got no risk, the return will be most reasonable. So it will be average out. Your risk will be average out, your return will also be average out. So please religiously follow the concept of diversification of assets or investment portfolio. That is a must for investment success. Now we will go where, what are the products available in the market for investment for the middle class, salary class person. I will just name because I don't have time. So I will just, first category where you can invest is governmental small saving scheme. Government of India is running some good investment scheme for the middle class, salary class. But good, I am using the word huge, good, not very good. Because in governmental scheme, most of the scheme, you will get the most reasonable return. And sometimes no real return even. But still there is 100% safety. That is why I will prefer as a middle class, salary class person that I should invest a good amount of my money into governmental scheme. And what are the governmental schemes? I will just name them. Mr. Sabdar, just keep mentioning in the chat box quickly. The first is Public Provident Fund Account, PPF. Please get the details of all these schemes through websites and government websites. I don't have time, otherwise I would have details. Second is National Saving Certificate, NSC, National Saving Certificate. Third one is Kisan Vikas Patra, Kisan Vikas Patra. Fourth one is RBI bonds, RBI bonds. Fifth one is government securities. Fifth one is government securities. Then post office and banks have got some small saving schemes which you can also look at. Then Government of India, big institutions like railways, national highway authorities, ONGC, they also keep raising loan from the public. You can also invest in. All these are under the umbrella of governmental small saving scheme. The beauty of these schemes are that there is no risk at all. Whatever government promises you, the government will give you in return or interest. And when the scheme matures, whatever the maturity amount, you will get it without fail, because it is a sovereign guarantee. So in governmental schemes, returns are most reasonable, not extraordinary return, but 100% safety. So those who are already crossed 60, their best bet is to invest only in governmental scheme, because they can't take risk now. But for you even, you should invest some portion of your investment into governmental scheme. Then real estate is there where you can invest. Then gold is there where you can invest. In gold also earlier, we used to invest in physical form only. You are from Tamil Nadu and you have seen in your families that in Tamil Nadu, good amount of gold is available even with each and every middle class family. And it is happening not today, for generations together. Gold was termed as a security valve for the families. It was a security valve for the family. That is why we were accumulating gold. And most of the gold were accumulated through jewelry. But my dear friend, it is a losing proposition. I will not recommend that you should now purchase gold jewelry in physical form. Now gold ETF is available. Exchange traded funds are available. Now gold is available in digital form. And I will rather request all of you, please consider purchasing gold in digital form than in physical form. Then security market is there. But security market is a riskier proposition, I want to tell you. It is purely knowledge-based market. It is purely knowledge-based market. Those who don't have knowledge of the market must not invest in the security market directly, because they don't have knowledge. But unfortunately, it is happening today. Majority of the retail investors don't know about the security market, what security market is, how returns are generated, what are the companies, what is the performance of companies, what is the management of the companies, what is the profitable. They know nothing, but still they are investing. Why? Because other people are investing. So are we fools? We must not invest in security market unless and until we have knowledge of the market. Mind it. If you have knowledge of the market, gain it. If you don't have knowledge, gain it. Now we are living in an era where every information is available in your mobile, in your laptop. You just go to any website and read as much material as you can for hundreds and thousands of hours to gain knowledge. So please, before investing in security market directly, I am using the word directly, you must have reasonable and rather good knowledge of the market. Otherwise, you should not invest. But there is an indirect way of investing that is called mutual fund. And what is mutual fund? Mutual fund is an indirect way of investing. You are not directly investing. You are not directly investing. What you are doing is, what you are doing is, that you are giving your money to the experts. And those experts are called as mutual fund managers. They are experts of the market. They have knowledge of the market. And they are supported by a huge research team, very strong research team. Before investing a single penny in any of the security, that research team will go deeper into the company, what the company is, what they are making, what has been their profit proportion in the last few years, what is the style of management, what is the level of management, what is the product company is making, and what is the potentiality of sales of those products, what is the competition around that company. All these things will be looked at deeply before taking any investment decision. So mutual fund investment basically is a scientific way of investing. It is not the fluke that somebody invests and he get money. No, it is not fluke. It is strongly based on the recommendation of the research of each and every company before investing a single. That is why it is called scientific way of investing. Mutual fund is an indirect way of investing because you are not directly investing into any of the products, but you are giving money to the fund manager, then they are investing. Why you are giving money to the fund manager? You can ask the question, very valid question. Why I should give my money to them? Because of three reasons. The first and foremost reason is I don't have knowledge of the market, but they people are the market experts. They have been in the market for 15, 20, 25 years. Second reason is I don't have time. I have got a full-time job, and then I have a family to look after. So I don't have time. And my dear friends, investment is a full-time job. You will have to be alert all the time. So they people are 24-hour managing your money because they get money out of, they get salary, they get commission. They are not social workers. They are managing your money. Definitely they will get some commission or fee or whatever you say out of that out from you. And third thing is you don't have any knowledge or experience of the market investment, but they people have been experience of 15, 20, 25 years. They have been managing investment for last 25 years. So they have got a very good experience of management of investment. Because of these three reasons, we give our money to them. Then in mutual fund schemes, there are hundreds of schemes are available, and every scheme has got a special purpose, distinct purpose, and every scheme is suitable to some category of investors. There are different categories of investors. A category of investor is young people like you who can take very high risk. Then for you, a different scheme is available that is normally called equity funds. In equity fund, risk is very high, but the probability of reward is also very high. In second category, hybrid funds. In hybrid funds, some of your money will be given, will be invested into the equities of the company, and some of your money will be given as a loan to the companies. So you are balancing your risk. And these are broadly suitable for individuals who have already crossed 40, but below 50 or 55. Then third category is where your money will be given as a loan to the corporates. It is called debt funds. Here, your money will not be invested into the equity share where the risk is very high. Rather, it will be given as a loan. The loan has got two things prefixed. One is rate of interest and second is the tenure of the debt instrument. So risk is very low relating to the equity fund, and these debt funds are suitable for the persons who are above 45 or 55, 60 and above. So there are different categories of schemes available as per your risk appetite. Likewise, in mutual fund, schemes are available as per your time horizon of investment. You can invest even for a single night, my dear friends. That is called overnight funds. You can invest tonight, withdraw tomorrow morning, you will get some return. Of course, very marginal one, but only for single night you invest and you get return. Likewise, if you want to invest only for a week or for 1 month or 2 months or 3 months, liquid funds are available. Then from 3 months to 6 months or one year, ultra short-term debt funds are available, where you are investing only for 6 months or 1 year. Then for little bit longer period, 3 years to 5 years. Short-term debt funds are available. Then above 5 years, 10 years, 15 years, 20 years, 50 years, normal debt funds are available and equity funds are available. So you can invest as per your risk appetite through mutual fund, and you can invest as per your time horizon of investment through mutual funds. In mutual fund, investment is very easy and so is the redemption. You can invest online. Now that everything is driven by the technology. You need not go to any place for starting operation. Go to the website of the mutual fund company, identify the scheme, give your information and bank details, you are invested. No need to go somewhere else. But if you are a first time investor, then you will have to complete your KYC first. That too can be done by eKYC. When you open a bank account, bank manager will ask you a lot of documents, or they will ask for. Likewise, when you are the first time investor in security market, including mutual fund, you will have to go through the eKYC route. Once your KYC is complete, then you are ready to invest. So mutual fund investments are subject to market risk. What does it mean? It means your money is mostly invested into the market. And market is not a constant factor. Today market is going up, tomorrow market may go down. Nobody can control the market because market is driven by lot of external factors, internal factors and external factors. So that is why the risk is there, and that is why always you hear the proviso that mutual fund investment are subject to market risks, or in security market investments are subject to market risk. So risk is there, but so is the reward. Equity fund has given 18 to 25% return for last 3 to 5 years. Where you got such level of return? No, nowhere. But then again, risk was there. And next 3-5 years, you will get the same level of return? No. Again, emphatic no. You may get even a higher return than what you have got in last 3 years. Or rather, you may get lower return. Or rather, you may lose some money if the market goes abruptly down because of some external reasons. So that is why the crux of the mutual fund investment is, if you want to make money through mutual fund in mutual fund investment, the only precondition is you have to be a long-term investor. You should not invest for a shorter period of 1 day, 1 year, 2 year, 3 year. No, you may get high return. That is a possibility. But if you are a long-term return, long-term investor, that is minimum 5 years. Just hold on for a minute.
Sir, please unmute your audio option, sir. Please, sir.
So when you invest the money, it will go only through your banking channels, your banking account. And if you withdraw the money, if you make redemption, that money will also come through banking channels only. So there is no cash transaction. Mind it. So there is a least possibility of fraud in mutual funds. Least possibility. Because everything is through banking channel only. When you get rid of, your money will never be transferred to any other account. Never. It will be transferred to your bank account only. If you change your bank account, give the proper and timely intimation to the mutual fund manager where you have got invest. And the best thing you can do, how you can make best use of the mutual fund investment is through SIP, particularly those who are those who are salary class, middle class person. And what is SIP? Systematic investment plan. SIP, systematic investment plan. And my dear friend, it is nothing but a recurring account. Every month you are investing. Every fortnight you can invest. Every week you can invest. So it is nothing but regular investing. And normally we get salary on monthly basis in India. That is why most of the SIPs are on monthly basis. Every month you are investing. The minimum amount of investment in SIP is 500 rupees only. Maximum there is no limit. Maximum there is no limit. And you can start not one but more than one SIP at the same time. And I know a lot of my friends who have started 5-6 SIPs simultaneously, and every SIP has some target. One SIP for purchase of house, second SIP for going on vacation, third SIP for higher education of children happening after 25 years. Already started investing money for your children's education. Then fourth SIP for marriage of children, and last SIP might be for your retirement life. So you can start and continue with a number of SIPs. These are called target-oriented SIPs. You have fixed the target. You have started SIP with a special purpose. And there is a other unique way of in SIP, that is called step-up SIP or top-up SIP. Step-up SIP or top-up SIP is nothing but you are increasing your SIP amount every year. Suppose you are started with 500 rupees. Next year, you increase it by 10%, that is 550 rupees for the second year. Again, for the third year, again add 10% of the 550, that is 610. So likewise, every year you are increasing the amount of SIP. It is called step-up SIP or top-up SIP. And my dear friends, it's a magic. After 10, 15, 20 years, if you go with a step-up SIP, you will have lakhs and lakhs of rupees in your hands. So please get, first of all, my dear Ananthi, I will rather advise you as an elder brother, don't go for trading. It is not your cup of tea. We are middle class, salary class person, and this trading, jobbers, and F&O segment is not for us. You need to be a long-term investor. You should not be a trader. You should not be a jobber. You should not go for the F&O segment. This is not the cup of tea for the middle class, salary class person. Rather, SEBI has come out with a report very recently that 90% of the retail investors have lost money in F&O segment, future and option segment. So I will also request you not to go for the trading, not to go for the jobbers, not to go for the F&O segment. Be a regular investor. Invest for a longer period. If you do it, there are very brighter chances that you will get good return over a period of time. So I was talking to the SIP. SIP is a magic for middle class, salary class person. Mutual fund is a subject where I can speak for the next 2 hours, but time is a constant. So next time when we will have time, we will have a dedicated discussion on mutual fund next time. But how to get knowledge of the mutual fund? how we get the authentic information on every aspect of the mutual fund. Yes, my dear friend, there is a website. Please note down the name of the website. This website has been developed by AMFI, and every information there is authentic, no hearsay. And the name of the website is Mutual Fund Sahi Hai. Mutual Fund Sahi Hai. It is a name of, please visit the website. Everything about the mutual fund is available here. Short video of 1 minute, 2 minutes, or you will understand the concept of mutual fund. What is mutual fund? How it works? What are the different schemes in mutual funds? How returns are generated in the mutual fund? What are the different categories of schemes available in the mutual fund? What is the different options of investment in the mutual fund? Everything. How I can start investment, how I can start SIP, how I can invest lump sum amount, how I can withdraw money from the mutual fund when I need the money. Everything is available. Please visit the website, devote your time, not once, but next for 1 or 2 months, you should be visiting mutual fund SIA website daily. Keep reading the material, understand the concept first. Only after that, if you find yourself comfortable, not because I am saying, no, don't go with my advice even. No, not at all. But go with your own thinking, on your decision. But before that, please understand the concept of mutual fund thoroughly. Only then you should invest. So next time we will talk at length about the mutual fund. 2-3 things I want to tell you here is, prosperity, my dear friend, is prosperity is your right. Every individual has got right to be prosper. And my definition of prosperity is very simple. My definition doesn't mean to be a Mukesh Ambani or a big industrialist. No. My definition is very simple. I should have money for my needs. I should have money for my comfortable life. I should have money for giving comfortable life to my family. I should have money to give best education to my children. I should have money for leading a comfortable retirement life. All this is my prosperity. And my dear friends, prosperity is your right. It is your right. Every individual has got right to lead a comfortable life. But my dear friends, it is not your luck. Prosperity is not your luck. Mind it. Unfortunately, we Indians believe much on luck. Whatever in luck, we will get it. No, this is wrong thinking at all. Prosperity is not your luck, my dear friends. Prosperity is your efforts. Prosperity is your sincere efforts. So please make efforts for your prosperity. Nobody has stopped you. Who has stopped you to make efforts? We should make efforts. We should be sincerely making efforts for your prosperity. And please mind it, you will repent after 25 years if you don't make efforts. Nobody should be blamed for if you are not prosper after 25 years. Only you will be responsible. So please mind it. Be sincere in saving. Be sincere in investment. Make the best use of investment products. Earn the maximum real return and keep reinvesting it as power of compounding. All these things which we have just today discussed, please go for it. And I am confident that with this, everybody will be prosper after 25 years. And that good wishes to all of you. Thank you very much for giving me opportunity. Now, if you have got any question, please raise your hand. We will unmute you. You can ask the question directly. Please come forward and ask the
Mr.
question.
Surikanta Sharma, sir, for your beautiful introduction. For your beautiful thing all over around. And now we start the future of tourism, emerging trends and technologies. Is my slide visible to everybody?
Yes, sir.
The future of tourism, emerging trends and technologies. Like everybody knows that tourism is just booming all around for the emerging trends and technologies which is going around. Tourism is constantly evolving, driven by technology advancements, charging consumer preferences, and a growing awareness of sustainability. The industry is witnessing a surge in innovative trends and technologies that are reshaping the travel experience. The shift to sustainable and responsible travel, which we have eco-friendly accommodations as well as responsible tourism practices, which includes travelers are increasingly seeking eco-friendly accommodations such as green hotels and sustainable resorts that prioritize environmental conservation, as well as the responsibility tourism practices, which says tourism focuses on minimizing the negative impacts of travel on local communities and environments, promoting cultural sensitivity and ethical practices. Sustainable transportation. Travelers are embracing sustainable transportation options such as electric vehicles, bicycles, and public transportations to reduce their carbon footprints. Personalized and immersive travel experiences, AI-powered recommendations, virtual and augmented reality experiences, interactive travel apps, which comes forward with AI-powered artificial intelligence algorithms analyze traveler preferences to deliver personalized recommendations for destinations, activities, and accommodations. Virtual and augmented reality technologies allow travelers to virtually explore destinations, experience cultural events, and interact with local communities wherever they're going so that they can go and just visualize whatever is happening in the local communities. Interactive travel apps, which comes forward with the mobile applications providing real-time informations, navigations, booking services, and interactive travel guides, enhancing the overall travel experience. Forward to the rise of experiential tourism, which is into adventure tourism, cultural immersion, and wellness tourism. So moving forward with adventure, travelers are seeking adventure experiences such as hiking, kayaking, and scuba diving that offers a sense of excitement and exploration. In cultural immersion, tourism involves immersing oneself in local culture, traditions, and customs through activities such as cooking classes, language lessons, and traditional arts and craft workshops. Tourism of wellness focuses on improving physical, mental well-being with destinations offering yoga, retreats, spa treatments, and healthy cuisines. Advancements in travel technology, biometric authentication, facial recognition, and other biometric technologies streamline airport security checks and personalized travel experience. Smart luggage features GPS tracking, interactive scales, and charging ports, enhancing convenience and security during travel. In contactless travel, mobile payments and contactless check-in procedures minimize physical contact and enhance hygiene in travel settings. Artificial intelligence and automation in tourism, which says personalized recommendations, chatbots and virtual assistants, automated travel planning. In personalized recommendations, AI algorithms analyze travel preferences and history to provide customized recommendations for destinations, activities, and accommodations. Chatbots and virtual assistants provide 24/7 support, answer questions, and assist with booking and itinerary planning. AI-powered tools automate travel planning, suggesting itineraries, booking flights and accommodations, and managing travel documents, which is into automated travel planning. Let's go move forward with the sharing economy and the future of accommodation. Airbnb has revolutionized the travel industry by connecting travelers with homeowners offering short-term rentals, providing affordable and unique accommodations. Boutique hotels offer personalized experiences and curated amenities, catering to travelers seeking a unique and intimate stay. Glamming or glamorous camping combines the comforts of traditional hotels with the outdoor experience, providing a unique blend of luxury and nature. Leveraging big data and analytics in the travel industry, which gives predictive analytics, customer segmentation, personalized marketing. In predictive analytics, analyzing historical data to forecast travel trends, demand patterns, and pricing strategies. In customer segmentation, identifying and targeting specific customer segments based on the travel preferences, demographics, and behaviors. In personalized marketing, we have using data to personalize marketing campaigns and offer targeted promotions to individual travelers. The importance of digital transformation in tourism, user-friendly websites, and social media marketing. The travel businesses must create websites that are user-friendly, mobile responsive, and provide seamless booking experiences. In social media marketing, utilizing social media platforms to connect with potential travelers, share engaging content, and build a strong online preferences. In the conclusion of embracing the future of tourism, the future of tourism is bright with exciting possibilities driven by technological advancement, evolving consumer preferences, and a growing emphasis on sustainability. Embracing these trends and leveraging technology with the crucial for success in the dynamic travel industry. This was all about the future of tourism, emerging trends and technologies, which we can see all ahead about. I would like to take a privilege to give vote of thanks for today's national webinar. Respected Dr. Ujjwala Sonavne, Principal, Magarpatta College of Hospitality Studies, Honorable Mr. Suryakant Sharma, Senior Consultant, AMFI, former HDM SEBI, distinguished faculty members, students, and participants. I would like to take this opportunity to express my heartfelt gratitude to each and every one of you for making today's national webinar a resounding success. To Dr. Ujjwala Sonavne, thank you for your invaluable guidance and support in organizing this event. To Mr. Suryakant Sharma, we are deeply grateful for your insightful expertise and valuable time. To having in collaboration with Association of Mutual Funds in India, AMFI, we are also thankful to them. To our esteemed faculty members and students, your active participation and engagement have made this webinar truly enriching. To all participants, we appreciate your interest and enthusiasm in joining us today. Thank you to everyone who worked tirelessly behind the scenes to ensure the smooth execution of this national webinar. Your contributions have made a significant impact, and we look forward to continued collaboration. Thank you once again. We will keep the link open as the feedback link has already been put up in the chat box. The participants who will fill up the feedback links will only be giving the certificate. Thank you once again.